Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our FSC show. We're going to talk a bit about production, what is happening with activity in the market, and then just some high-level economic data that's come out. We'll keep it kind of light because we did a decent amount of data over the past week, and everyone wants to run to their weekend. So we'll try to keep it as short as possible. So when we look at the frac spread count, you can see that we're just at 285, so there's no change week over week. And to be honest with you, and again, like one of the things is I was expecting to have a little bit of a bounce this week, but going back through the seasonality, and it's something that we have in our insights, you can see that it all comes down to what day does the 4th of July fall on? Is it a Friday or a Monday or something in the middle of the week? So going back and looking at the data, we actually should still be fairly flat this week. And then it's really next week that we not so much go back really go back to where we started right before the 4th of July weekend, which would be about 290. And then from there, again, we expect to get a little bit more activity from some key areas. And just to list them out, would be the Williston or the Bakken, Western Gulf, and then in the Anadarko. And realistically, the Permian is already fairly elevated. There's about 2 additional spreads that can come on in the near term. But the delta between the 290 that we're talking about and the 300, which is about 10, it really comes down to the seasonality. And to be clear on what that means, a lot of the smaller basins, they typically move in 6-week increments where they'll pick up 1 or 2 spreads for about anywhere between 4 to 6 weeks, do the work that they have scheduled, and then let that spread go. And that's typically what we see happening, and that's going to be the delta on that 10 of getting from that 290 to the 300, because the Permian is fairly tapped out. There's some spreads here or there, but there's, again, activity's been very robust there. Same with the Western Gulf. Anadarko has some spare equipment. The Williston has some spare equipment. Same with Appalachia. But when you start looking at some of the others, like at the Cherokee, the Arkoma, the Ardmore, those are ones that currently don't have, Arkoma and Ardmore especially have nothing happening right now. And we typically have 1 or 2 coming back at this period of time. So when you start looking at some of the smaller bases like the San Joaquin, the Powder River, the San Juan, that's where you typically get a little bit of a pop. So again, if you take 5, 6 of these basins and add 1 or 2 spreads, all of a sudden you get that 10 to get you to that 300. Because some people were asking me, given where utilization rates are on these spreads, how can we get to 300? And that's how. It's not so much that you're going to get this huge surge of 10 spreads in the Permian. It's these ones and twos throughout the U.S. that really aggregate to something that we're talking about. Now, once we get to that target of about 300, it's really, there could be a little bit of a flex higher, but we're really getting close to the maximum that is currently in the market without some significant rebuild, whether that be bringing in new pieces to bring some of that equipment off the yard. But again, right now, just given what our expectations are, because at the end of last year, we had said we viewed the 2022 exit rate of 12.2 million barrels a day. That was our target. Was that 12.2, maybe 12.3, but 12.2 was where we thought 2022 exit rates was gonna be, and we're sitting here right now at about 12.1. So to see another 100,000 barrels a day, so last year we were calling for kind of this move up and then a fairly stable frac spread count, and that's where we think the data so far is pointing us. Now, when we go to the rig count, you can see that there was an addition of 2 rigs in the U.S., 2 on the oil side, but they were all vertical. So realistically, horizontal directional, still fairly flat. Vertical, and for those that are new to this, typically a vertical well, you can drop a vertical well for production, or when you start doing some drilling programs, sometimes you'll have the vertical rig run ahead of the horizontal, just so that the horizontal rig isn't, I don't want to say wasting time, but let's just say wasting time going vertical. Instead, you use that hole and then use the horizontal to really make the pivot and to go horizontal instead of going down the creating the vertical well. So these are some things that sometimes it reduces cost, especially if the horizontal rig rates are going up. It's cheaper to have a vertical. It has less horsepower, less capacity to it. But when you look at the directional and horizontal, and you look at rigs in general, they're also having a little bit of a fourth July hangover, and we do expect to see a bit more activity coming in, especially on the oil and gas side at this point as we head into next week. Now, when we start looking at some of the key pieces, especially when we're looking at gasoline prices, diesel prices, I always love looking at these two different charts, because here you can say average U.S. gasoline prices see the biggest single day drop since 2008. And you might think oh, look how crazy this is, but it's 3 cents. And it's when you have such elevated levels and then you have a bit of a lackluster demand. And again, as we said on the EIA show, we got the spike in demand, which you're supposed to get. Nobody in their right mind would say that 4th of July isn't going to see a spike in activity. The question is, what is the spike in gasoline activity versus where it normally is for a 4th of July holiday? And you can see it was a bit light. So it was a bit light. It was still up. It should move. But the question now is, what happens next? And we do expect to see a pullback on just demand in general to, instead of staying between 9.5 million barrels a day to 9.7 with some spikes to about 9.9, we expect it to be between 9.1 and 9.3 million barrels a day of gasoline demand. Now, that's up from what we've been seeing about 8.6 to 8.7, but you're not getting that normal uplift just because of price, just because people are in a different position monetarily than they have been at different periods. And this just puts it into perspective. So clearly you can see that nice drop, and they liken it to 2008. But when you look at just where we're starting from versus 2008, and again, this isn't adjusted for inflation, because I know people will say, well, 2008 is still higher. But again, just looking at numbers in general, you can see that we were starting from $4.86 coming into the weekend. And then, when you look at that previous period going back to 2008, we were above $4. So again, when you're looking at things a little bit differently. So to have a 3 cent drop from 480 is very different than having a 3 cent drop from 350. So again, when you look at this in general, we're still at these elevated levels. And unfortunately for the supply chain and for sticky inflation, you still have diesel, even though it is coming down a bit, you still have diesel at very elevated levels. And now if we switch back to the frac spread count, diesel is used for fracking. I mean, you typically, obviously you have e-fleets, but you will have dual fuel, but diesel is a piece of this. And so diesel prices still remain high, and there's still going to be that demand that we're seeing. Now, we do expect demand to come down, but come down to 3.9 to 4 million, not back to where we were at 3.3 on the diesel front. So again, still a lot of staying power at these levels. But when we start looking at the market in general and where rates are going, because we had the jobs report, the jobs numbers came out strong, and I want to go back to, and I would request or hope or would like people to watch segment 2 of the Econ Show, because we talk about how jobs can keep going up, but at least at the beginning of a recession. And so really jobs, you don't need jobs to go down to have a recession. You can have a recession and have jobs keep going up, just because there is a lag. There is some of this follow through that we're going to get. But when you start looking at the Fed and you look at bond volatility, which is excessive, and again, one of the things that we've talked about is the Fed wants to make sure, and central banks in general want to be able to manage rates. And when you lose control of rates, you start to lose control of a lot of things. So when you look at the jobs data, when you look at the inflation data, there is room to do another 75 basis point hike. Not now, does it mean that they're definitely going to? No, but it means that based on the data, a 50 to 75 basis point hike is absolutely going to happen. I think I would lean more towards the 75 basis point. I know that they have tried to say that isn't the case and that a 50 is more likely. Again, that we'll have to see how that goes. But there is a fairly sizable bond auction coming next week, which would add about $95 billion worth of treasuries to the market. And that's going to be a lot to absorb. So again, there's a lot of things to manage. But the problem with the bond volatility, obviously 2020, we had this massive spike and then this drop. We're not dropping. We have this continuous volatility, something similar to 2009, which is what they're trying to get in front of, which is what they're trying to get to bring back down, because this is where you start to lose control. And this is when you look back to the 70s, when you start losing rates is when you start losing more and you start to get wilder swings. And that's what they're going to try to get in front of. Now, back to the report that we had said, the non-farm payrolls were expected to be at 265. They came in at 372. Very strong number versus expectations. Unemployment rate was the same. Average hourly earnings were flat. They were slightly up for where they were year over year. But unfortunately, the trend is down. And that's something that we're going to talk about in a minute, because yes, it beat estimates, but it's still below where it was. And again, this isn't adjusted for inflation. So you still have inflation at high levels. You have inflation moving up, but you already have hourly earnings coming down. And again, that's some of the concern that we have. And then now the labor force participation rate actually came down. And again, it was a small number, a small miss. It was expected at 62.4% and came in at 62.2%. Now, that's a concern because if you don't get the labor coming back, then you keep some of this tightness in the labor market, and then that keeps wages elevated, which again is one of those tailwinds that we've talked about for inflation. And these are some of the things that they're going to want to try to, again, get in front of. And now wholesale inventories, missed estimates, came in a little bit lighter, but still, again, we're still seeing those inventories grow. Now, moving to the labor force participation rate, you can see here that we're at 82.3%. And then, now this is looking across everything. So this is looking from ages 25 to 54, that prime, let's just say the prime workforce age, went from 82.6% to 82.3%. So when you look back over time, you want to see this get back to where we were pre-COVID. But as we were saying, some of the jobs that were there that people were let go from, they're not coming back. So people have to pivot. And that pivot is taking time. And at the same time, by keeping the participation rate fairly low, you're maintaining wage pressure. And that's another thing when you look at what the Fed is focusing on outside of rates and volatility and obviously inflation, it's how do you avoid a wage spiral? And the participation rate coming down actually hurts that, because then wages stay bid because you have to pay people to come in. And then all of a sudden you have inflation going up, so you have wages. So then wages go up to match inflation. And then as wages go up, you have to keep raising prices, which is keep pushing up inflation. So again, you can see that there is why it's called that spiral. Now, when you look at the average hourly earnings, you can see here that it continues to trend lower and moving in a direction that is going to increase the pain, if you will, to the consumer, because even though wages step down, you still have inflation stepping up. And just looking at that a little bit differently, here's where you have that kind of flatlining, and now it's flattening, and now it's starting to roll. Now, average hourly earnings coming down is actually a good thing for inflation, because as wages start to soften, then you have some of that cost when you think about COGS and you think about how companies create their price. That pressure starts to come off, and then they can start taking their prices down a bit, or at least stop pushing them up. Which again, this back and forth that we keep talking about. But when you start looking at inflation, here's some contribution across the OECD. Again, this is for May, so we know that June and so far July is already higher when you look at some of these key countries, because when you look at energy and food, it remains a huge driver of pain. As we know with Italy, there's rumors that Libya is going to cut 25% of natural gas flow to Italy, which would only put them in even worse position. But it's important when you look at the U.S., where energy is still a small percentage. And again, relatively speaking, given against the UK, Germany, the total less food and less energy is a huge driver for the U.S. And a lot of that is sticky. And that's where, even as we get some of the benefit on gasoline prices coming down, there's still a lot of staying power in that, which again is going to lead to some of these problems as we continue to get some things getting much worse. But when you look at consumer price on the headline side, you get an idea on just how impactful energy is on some of that those levels, where that'll come down, and it could come down fairly quickly. Obviously, it's not in June, as we know what happened in June, but so far in July, we're getting some of that benefit, at least in the U.S., not so much in the UK and Europe, as natural gas prices are actually hitting new all-time highs, not less, and driving up electricity prices to new all-time highs, as you have natural gas prices moving back up. But so the U.S. is still getting impacted, but just knowing back to the previous chart, there's still a lot else out there that is driving up price, that is keeping some of the stickiness, which is what the Fed is going to want to try to get in front of. And here's some of the ones that we've been talking about. Now, for those that have been following us, we've been saying that there was a lot of risk of an additional pressure on the food side. And here's where we continue to see the analysts continue to trim the 2022-2023 outlook to a 7-year low on world wheat stockpiles. International wheat and maize markets are expected to stay tight. This means prices will remain volatile and continue to be highly sensitive to daily news on crop developments, weather conditions, and policy changes. And again, this is just supporting how we believe that crop and food prices are going to remain very elevated on a global basis. Now, when we pivot over to China for a moment, I think it's important to talk about how stimulus remains this big thing where everyone's like, oh, they're going to stimulus packages. But look at the reserve currency, and a lot of this is in dollars, and just look at how it's coming down. This is, again, pointing to exports are slowing, so they're not bringing in as many dollars as previous. And at the same time, they also have to stimulate. And if they're trying to stimulate where you're going to liquidate some of your reserves in order to drum up support, to try to create some of that, and that's failing. And you're not getting the same type of movement, you're not getting the same type of reaction, you're not getting the same type of exports, and that's really draining the reserves. And the reason why this is becoming a bit more of a concern here, these dollars, these treasury bills are acting as collateral against the currency, against bonds, against some assets at the bank level and PBOC level. So as dollars come down, as foreign reserves come down, the fear on inflation starts to increase. The fear on what linkage, what is really backing this, what really is the collateral that's there. And then when you start looking at where they're trying to focus on investment, it remains in the industrial sector. And here you can see just the amount of investment that's coming into the industrial sector. And it's really been focused for a while on the service side, but now they're going heavy again back into the industrial sector. And we've already heard from a lot of local entities, local governments, that there's just not a lot left to invest in on the industrial side. So that's why we continue to think that the stimulus just isn't going to go all that far in terms of what will be, let's just say, a meaningful bump to economic growth. And now rounding that out, one of the leading indicators for global exports has always been the Korean market and the Korean full export level. So as we had said this past week on our EIA show, Econ show, I think it was segment 4, and then in the EIA show in segment 2, we are seeing global trade slow. Again, it's not like this huge, massive drop, but we're seeing it slow. It's, we're seeing supply chains catching up a little bit. We're seeing some inventories building. We're seeing new orders are dropping, as we've been talking about. New orders are contracting. You're having new export orders contracting. So Korea is just confirming what we know, which is going to slow diesel demand a little bit, or marine gas oil. You're going to see some of that again dropping out. as we have some of this, global slowdown that continues. Again, you can still see it's positive, and we're not saying that the global economy is in a massive recession. It's just moving in the wrong direction. It's slowing. There are parts of the world that are in a recession. There are parts that are right on the brink, and there's some that are still doing fairly well. ASEAN nations, as we talked about in this past week's show, Econ show, their manufacturing's clipping along at a stable pace. We think it slows, but it's still expanding. So again, these are things that we're always going to continue to look at. So if you have any questions, please let us know. We always appreciate the feedback in the comments section, or you can find me on Twitter. Next week, we're going to do more on natural gas due to one of the requests that we had, just to look at, now that we're in the middle of July, where are natural gas storage? Where are we going? Where are the bottlenecks? And I think that that'll be a good way to look at what's happening in the world and what do we see coming. So hopefully everyone had a great shortened week, and thanks again for watching, and we hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.